Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein, and here we are. And this is Monday, the 12th of September, 2011, about 2:40 in the afternoon. The stock market was down much more than it is right now. This is a good rebound, and I think it gives us an idea that we might be ready to see bounces, in fact, rallies in these markets. They've come down very hard. The worst didn't happen. I think you got down low enough in some of these stock indices to get a bounce. And in fact, you haven't even turned the trend down in the NASDAQ and the S&P. You have in the Dow as far as I'm concerned, but not the other two. In the metal markets, well, for those of you that are die-hard bulls, today's been a hard day. You're sitting here down $44 or so in the gold market, and this is a chart of December gold. The market was going sideways for a while, got that summer August rally, poked up just in early September, and we're still at early September for all purposes, and has been headed down a little bit. Let's widen the chart out and put on the swing line because I think it helps you understand what's going on. What the market has done right now is it's set up a pattern of lower highs and higher lows. This high of the low today is 1804. The previous break low is 1793.80. But if I remove today on the chart, you have a lower low here. We didn't know where this high would pop up, and it's there. So I think that you could define the trend as down. In other words, lower highs, lower lows, and we'll see where today's low carries. Let's assume I'm right. Unusual, huh? And the market gets under 1793.80. Why is that important? Well, I want you to look at where the red line in the sand comes in. This is called the 18-day average of closes. The market is right now trading under that. That number is 1829, and I believe it'll close in that area by the end of the day. I forgot to look exactly where it was at 12:30 Chicago time, but it's immaterial. I'm just looking for the market to play in that general zone. Let's assume that it takes out 1793.80 because the pattern is one of lower lows, lower highs. Got that? Okay? Support, one of the areas is the 45-day average, which happens to be under the market. It's not always that way. So 1720 is one support, 1611 is another. Where's the Bollinger Band? The Bollinger Band is 1754. So the most likely scenario, if 1793.80 is taken out and the market were to pursue falling further, is support around 1754. Let's go the other way. Let's assume the market doesn't take out 1793.80 and takes out 1889, the high that you made on Friday. Well, then you're in an uptrend, but you run right up to the Bollinger top of 1903.60. So I don't like that either. What I'm looking for is nowhere. I'm looking for the market to just be up a day, down a day against the 18-day average of closes, and you don't even have momentum setting in. Your slow stochastic study is sideways. I think the market got damaged 4 days ago when it hit 1793.80 and broke the pattern of higher highs and higher lows. And I think now the market is like a spring. It needs to wind itself up. The seasonals at this time of the year are definitively to the upside. In fact, they go this way right into December. So pullbacks in the market I view as welcome opportunities. The way that I teach trading, I certainly would not be telling you to buy this break. I'd rather actually buy the market as it's going higher rather than pick the break low right here. I think it's too volatile. But here's the other thing that's good. Volatility is gradually coming out of the market. This is where it's hard to trade. When a market just runs, you either buy it blind and just put a make-believe stop in, or you let a market start consolidating and winding itself up. That's what gold needs. And where's it winding itself up? At a new high plateau. It did this back here in this general zone, and it's trying to do so right now. In the silver market, you're in a downtrend. You've got lower highs, lower lows, well under the 18-day average. Momentum is pointing down here. So I'm going to look for the 39.40 area to be a support zone. In the copper market, I would have told, if you had been my account today, to lift all short positions against the 393 zone. Why? Trend had been down, lower highs, lower lows. You hit the Bollinger Band. The odds of staying above or below this black line, this algorithm, is 2.5% of the time. Yes, there are times just like this when you can extend that. And that was the break where everything fell, but it doesn't matter. Forget the day of a break or the reason. Typically, you don't do more than 5 days, up or down. And those odds shrink each one of those days from that 2.5% down. Well, in this case, you hit it, and you just come from the 416 area down to 393. I mean, you might be looking for magic, and the market's just going to go all the way down, but things typically don't work that way. Rather, I would look for the market to find resistance at the 407.5 area. If you take out 415.95, you negate the downtrend that's at work. Here's the really interesting market, crude. The crude market is up nearly $1, while the stock market is down in the Dow about 100 points. They've broken away from each other today. One day does not make a trend, but it's certainly worth watching because for the longest period of time now, the proxy has been that if you bought or sold crude oil, it was like trading in the stock market. You were taking the same type of position. Today they're going different, and support is still one against the 18-day average, and you do have the pattern of higher highs and so far higher lows. You are overbought, fine, but it's certainly worth watching what's going on there. The Brent is doing the same thing. You've got the pattern of higher highs, and I want you to take a look when you hit these Bollinger Bands, how the market got thrown back to this 18-day average of support. I'm redoing my whole charting course as I am talking to you, and I mean I'm buried in it, and it will be done if I have my way this month and be released this month of September. And I'm really doing a lot more chapters with a lot more discussion on how this works, the ideas behind it, some of the probabilities, and just giving you some ideas from there. You'll hear more about this. The course will be up for sale again. It is now, but it's got a lot more in it, and I think you'll appreciate that. In any case, until you would take out 109.85, pullbacks to the 18-day average are still buying opportunities, but just like the WTI crude, you're overbought. You have a 70 reading in stochastics. When you're over a 70 or above, you're overbought. Gasoline's different. Gasoline broke itself down, and it's now got a pattern of a lower low, lower high. It's a bear market at this point. Maybe this is where they shift the demand for gasoline as winter comes on. You don't need as much, and you start looking at heating oil. That would not be the surprise at all. And I realize how bullish everybody is on notes and so on, and I'm probably the biggest bull you'll run against. But when you hit a Bollinger top, it is time to what? Cut back position. That's my theory. And the market is falling right from the Bollinger top in that market. You know, one of the things I like to talk about, be it on interest rates, and I think they're super important, is the cause and effect. What makes a move? Money supply, CPI. What's the impact of building on all this? Now, you think you know, but we've put together a sheet that really lays it out, and this is built for the Treasury market. So it gives you an idea of the cause, be it the supplies of things up or down, what does it do to interest rates, and I agree that we've seen government intervention, not only in our rates, but that now of our European partners, but somebody's starting to let up on some of that intervention. It's China. Keep your eye on that. It's going to be very important. I think that they're at the point where they don't have to intervene as much, and their goal has been probably going to be reached, a soft landing. But what their definition of growth isn't ours. We're struggling for 1-2%, and they're sitting there at double digits. They're in very good shape. But this cause and effect will help you understand how this works. It's part of our overall trading kit that goes along with the charting software that I have here, all the quote boards that we work from. By the way, it's the gold-silver ratio. You can do these. You can track ETFs on this, and we do that often. As you can see, the SPY is up here. We've got quite a few of the markets, Mark Leibovitz, TLT. You'll see the different ETFs that you can work with this. How do you get access to this charting software? Well, it's free. We want you to try it because it's really part of our trading platform, and it has paper trading in it, so you can practice if you'd want. And you do it by giving us a call, and that number, 1-866-973-2077. You've seen it on the bottom here. Or go to our website at www.iraepstein.com, and we'll send you out our futures trading kit. I'm Ira. You have yourself a good day, and I'll see you tomorrow.